welcome to the Reflective Ventures. We're going to talk a little bit today just about sort of the process that we go through at Reflective. So a couple of the partners are up here. Renal's over here. David's up here, and we'll sort of swap back and forth. The idea is we'd love to get through this in, like, we can probably do it in 20, 30 minutes and then open it up for questions for anybody in here that wants to ask us. So I'm Greg Heuss. And I just wanted to talk first. Some of you guys may have seen some of this if you were at the governance forum. So I wanted to talk a little bit first about how the fund's actually set up. So this is very, very standard to how any venture capital fund is set up. So it's an 80-20 rule, right? With the 80% going back to the co-op, 2% management fee. Again, very standard, the way that it all works. And I think everything got switched over, and we achieved and received the rock. That was at the end of January of this year, 100 million rock. That's what we're calling Fund 1. There were certain tenets that we had to follow within that agreement that we had with the co-op. One of them was that we would invest in a minimum of 12 companies in this first year. We would do 8 events in the first year, and we can talk a little bit more about that. And we would create a workspace. You've probably all heard me talk a lot about that, and we'll go into that with some more detail. So that's kind of how the fund is set up. Nothing special or anything about that. Very, very standard. So David, I'll let you talk a little bit about this one.
Hi, how's it going? I was talking to a couple people yesterday, last night, and we were discussing this structure, how how Reflective interfaces with whatever you call a portfolio company or a spoke. But the idea is what Reflective is looking to do is design a relationship between sort of 3 parties: Reflective, Archain, and the company, the decentralized application, the what we call a spoke or a portfolio company. So there are 3 parties of interest. And one of the important things to know is that our sole investor and limited partner is Archain. And our mandate, for the most part, is to ensure that what we are doing relative to the establishment of these relationships is ensuring that the business proposition that we identify is committed to deploying their technology onto the Archain blockchain. So that's a little bit of a dance, right? Because the Archain blockchain does not yet exist, and that's in part why we're having sessions like this. And so the term sheet or the strategic partnership agreement is really designed to say, okay, where's the company in the state of its evolution and development with respect to its technology? We can pretty much tell you where Archain is, or we certainly have access to the information we need so that we can determine where Archain is. And then Reflective stands in the middle and says, okay, what are you going to need to get to the point where, when the Archain blockchain is prepared for launch, Q4 of 18, that your technology will be ready to deploy onto the blockchain simultaneously or near simultaneously. I mean, we're not looking for exact dates, but we are looking for commitment, and we are looking for alignment around both use and timing. In other words, if you're 5 years out, we should probably talk later. But if this is a near-term event within the next 12 months, then we should be talking. That we should be talking. So that's one of the first things we need to get clear in all the relationships. Now, does that mean that, and I've had this question a number of times, does that mean that if Archain doesn't get out in Q4 and you're ready in Q4, that you have to hold off in your business model until Archain's ready to go? No. What it means, if you have another blockchain you can deploy to, then you can. What we're saying is, we think this blockchain is a bigger, better, faster alternative. You don't want to be talking to us if you don't agree, because there's a value proposition with the RChain blockchain that is compelling on a number of levels. We believe, I think everyone here does more or less. So, to the extent that that value proposition makes sense for your business, then it's a question of timing, near term versus longer term, and resources. The resources, demand, question, issue, really has to do with a couple of things. It has to do with, what do you need as a business by way of capital? Capital is the lifeblood of all businesses, big and small. So what do you need to move your business from where it is now to where it will need to be deployed on the RChain blockchain? And then that breaks down into essentially two components. One is the USD requirement, the fiat currency requirement, the things you need to pay people, things you need to pay the rent, and what you conceivably need. I know it's not a crystal ball, but what you conceivably need to run your business on the RChain blockchain. You're going to need Rock or Rev to power, to access your business proposition. And so some of that allocation needs to be considered. It needs to be considered for purposes of how you're going to deploy once that event occurs. Now, we can't really tell you what that is. We can go through it, just like we go through with a token economics analysis and timing analysis. But we can't tell you what that is. That's more of a conversation that should be brought to the table and should be brought early to us. But assume we get through all that. There's this notion that crypto is a security. And there's a lot of that going on. How do you make it not a security, and how do you ensure that somehow you don't get trapped in this problem where you're selling an instrument that's a security and it's either not been exempt from registration or it hasn't been registered. And then so that's a sort of big umbrella issue that's going on in this space. And part of that analysis has to do with whether or not you treat, just part of it, whether or not you treat the instrument as an investment. And that's on both sides. It's not just in the initial sale. It's when we're going in to fund an opportunity, a portfolio, a prospective portfolio company. So what we do is we say, and I think it makes a lot of sense, otherwise we wouldn't be doing it, but we say this is a strategic partnership. The whole idea here is to assist in this sort of tripart relationship between RChain, Reflective, and the portfolio company. It's a three-party relationship, and it's strategic in many senses. It's strategic from a crypto deployment perspective. It's just strategic from a deployment on the RChain perspective, and it's also strategic from a perspective of how and when and what do you need to get to that point, the point where when the blockchain is live, you're there to be deployed on it. It doesn't turn into a train wreck. And so those are the sorts of things that need to be thought through and then addressed. The principal customized portion of the strategic partnership agreement is the Milestones section, and we have a strategic partnership agreement that lays out what we are going to do, what you are going to do, and then how this is going to work. And the quid pro quo is essentially USD and or ROC. You're bringing a commitment to deploy onto the RChain blockchain. We are also bringing access to space to develop your business proposition, your tech at our facility, which is going to be occupied by our chain as well, and that you're going to seek information, advice, whatever else you need from the our chain development side or marketing, and we are going to provide that to the extent you can't get it yourself. So we're not looking to abandon anyone by any means. In fact, we would be happy to have all portfolio companies in the space working with us. We know it's not practical, but the point is we think that the more we can facilitate and share information in terms of what the portfolio company needs and what our chain can provide and where they are and where they'll be from a deployment standpoint, that just is creating a greater likelihood of success for everyone. So that's how it works strategically. That's how we try to align the interests. We think that it aligns pretty well, primarily because we don't want to get in a situation where we've got somebody that isn't ready to deploy in relatively near term. This is near term. This is under 12 months now. We take the launch date of Q4 18 seriously. Given that, we're 9 months out, something like that, a little less. So you've got to want to meet that. Now, we're not saying if you're 2 years out, you're not a candidate, but let's articulate why it makes sense. Clearly, this becomes a lot easier once the blockchain's up. And well, easier in some senses, potentially a little more difficult than others. But that's the strategic partnership agreement. The milestones and the commitments around milestones are what are critical. That's where the rubber meets the road in terms of what you're going to do as a portfolio company and what we are going to do and we tranche it on a quarter by quarter basis, and what we are going to do on a quarter by quarter basis to help ensure that you get there. Because this is all about making sure both parties do what we are looking to do. And so that gets memorialized in a term sheet, in a strategic partnership agreement. A couple other things. So the consideration back for us and our services is equity in some instances. It's tokens in some instances. There's a lot of talk going on right now around a SAFT and the issuance of a SAFT and what that means from a security standpoint or securities compliance perspective. The SEC and the bar isn't particularly sorted out on these issues. But the analysis doesn't change. The analysis hasn't changed. So we're still in an environment where the SEC v. Heuss is the law as it relates to investment contracts. A SAFT is clearly a security. So what you're doing then is trying to peel off, okay, what happens when that SAFT, simple agreement for future tokens, what happens when that token is issued from that SAFT? And what does that look like relative to security or asset? And that's in the spirit of the SEC and the Dow report, a facts and circumstances analysis. So it's going to be really a function of what your business model is, how you're using it, when it's rolling out, when the SAFT converts, all that kind of stuff. So that's important. But the sort of foundational thing we work on is we're not looking at and making investments in the sense that when you get rock, you're flipping it. We're making funding strategic partnership agreements. And it isn't just a semantic difference. It's a you have to want to work in this model, in this framework, because it's not necessarily for everyone. We think it works, we think it can work, but you want to buy into what do you need to do and how you need to get there. And then what we'll do is say, first of all, we like the business. We think it works. We think it's a great application for the blockchain. Now let's put it together. And that's where the timing tends to slip, frankly, is that quarter by quarter analysis or month to month if the the fiat requirement and the dev requirement is such that it's a little tighter from a demand standpoint, the capital. That's fine too. But it just has to be done. And it's not, we're not saying, here's your $1 million, see you in 9 months. That doesn't work, not working that way. Does not work that way. It would never work that way. We've done enough of this in prior lives. So that's kind of it. But I'm happy to answer any questions that see the ROC allocation. As I said, there's a USD component or fiat component in addition to the ROC. You bifurcate that, as I said earlier, for the reasons we discussed. But everyone needs to bring some articulable strategy around what their business, how their business deploys on the RChain blockchain and what their business needs to do that from a ROC allocation standpoint. And then we adjust accordingly. Then that may be for the first quarter because you're ramping so quickly. It may be for a year out because it's going to take a little longer. And those are all discussions we have to have prior to committing. And those are all discussions that get reflected in the milestones section, which is Exhibit A to the strategic partnership agreement. So we talked a little bit about that, the platform. Oh yeah, a couple other things. I don't know that we have required it yet, but we will be. I think this is going to be new to my partners here, but we want everybody we're working with to be members in the co-op. We think that drives value both for you. Membership is $20, and institutions can be members too. So there shouldn't be any economic disincentive or impediment. But we think that there are a number of benefits for that relationship, because as a member, having membership, you have access to information, you have access to data, you have access to other members that you wouldn't otherwise have. So we think membership is important, and you're going to see it in the strategic partnership agreement. So the membership piece, and the membership piece is really more of a benefit to the portfolio company, in our view, because there's so much that you have access to that you don't otherwise see outside the membership base. So that's one. And then the other thing we do relative to a token generation event is for a portfolio coming in, that company that has not done a token generation event or is looking to do another, or there's some strategy for that. We want, and we will request, and it isn't 100% of the deal, but we want a right to sell some or all of that TGE to the membership, to the entire RChain membership. So what we think that does is, again, brings you as a portfolio company into a membership that where you see more and have access to more, as well as potentially, if you so desire, participate in upcoming and ongoing opportunities that are generating tokens. It's a distribution opportunity for a company, and it doesn't have to be much. There are companies we've talked to who said, well, if we're going to do that, we'd only want 5% of it. We've got it taken care of. That's fine. But we think it's important to provide that. We think as a distribution opportunity, it makes sense. And with the portfolio companies becoming members, you get a better perspective for what else is coming online. So we think that's helpful. That's kind of going through this stuff. So I guess that's it for me for now. Thanks.
Hey everyone. Sorry, all of us have a bit of a cold today. I'm Renal. I'm a venture partner at Reflective Ventures. I'm just going to cover the next 2 slides, talking a bit about our mandate and how we work together. Many of you in the room probably know a lot of this already, but just want to be completely transparent on how we do things and how something goes from an opportunity to a final strategic partnership. First, let's talk about areas of focus. We think the space is too big and it's too early stage to be to look at only one or two verticals. So by extension, we're vertical agnostic, and we have broad exposure across multiple verticals, or at least that's our intent. If you looked at the list of companies that we shared a couple of days ago, you'll see they represent a broad range of verticals, but we're looking to make that even broader, and we also want to broader access to geographies. While we are pleasantly surprised that we've had companies from Montreal, Spain, Africa, etc., which has been great. And finally, what we really like are use cases that weren't possible without a scalable blockchain before. You won't believe how many we see, how many opportunities we see which are just X but on blockchain, and that's not really what we're looking for. We want a use case that's, and glad to talk through that whole list of 24 companies, why we think they're perfect use cases for blockchain, and we think that's mandatory for a good deal. About how we work. So we have 8 team members. Each has an area of expertise. I think you all know all of us. All our bios will be up on our website once it launches closer to the end of this month. But also feel free to look us up on LinkedIn. And what's important is all of us have been on the other side of the table. So, and while I go through the process, a lot of it was just informed by the fact that, we've all either raised money for startups that we've done ourselves, or for other startups that are either our friends, relatives, or incubees. So we've been on the fundraising side as well. And so we have a lot of experiences about things we liked and things we didn't like. And naturally, we took all the best ideas of things we liked and adjusted our process accordingly. So I'll first talk about our diligence process. At a high level, we try to make it in weeks and not months. We try to get to know very, very quickly. So just so you know, the 24 companies that we listed is not exhaustive by any means. If you take every single opportunity we've looked at, Greg, in the hundreds, right? Yeah, in the hundreds, we're actually extremely selective. We'll have more details later, but our hit rate is actually lower than a lot of VCs out there. So we don't chase. We see a lot of stuff across our individual networks, which has been great. So we get to know fairly quickly, and we try to get to the yes in weeks and not months. Usually, once we say yes, it's usually something that we will do, and the only reason it could fall apart is because of structuring or valuation. Speaking of that, let's talk about the first thing. We do a very full review of financials. We think that's consistent with our fiduciary duties. We know some VCs are a bit haphazard about this. I come from a school of thought that's very value investing based. I worked at Bain Capital, and after that, a long-only, ultra long-term hedge fund. And so I try to take everything down to free cash flow when I'm looking at a company, and look at free cash flow yield to equity. We use business fundamentals to value the finances of a business, even though it's VC and early stage. We get that the range of outcomes is extremely wide, and we get that it's absolutely impossible to put a point on a projection. But we need to know what the economic implications of that spread looks like to accurately structure the deal and make sure that it's a structure that's beneficial to both the entrepreneur and ourselves. Another thing I'd like to add is we're extremely disciplined on valuation. A VC that needs to pay up to get a deal is a terrible VC. And this is advice I've given to every entrepreneur friend I've had. A good VC is great at structuring a deal appropriately that has the right rewards for both the investor and the investee. And you can do that through multiple ways. You can do it through equity, you can do it through options, you can give an investor buyback options to retake equity later. A good VC can always find a way to be disciplined about valuation, yet get you where you need to be. So, paying up for deals is just something we don't do. We pay very fairly, but we'll always be disciplined about valuation. And then the second bullet point is about deep review of end market dynamics. We take this extremely seriously. You look at most presentations, every industry has a $4 trillion TAM. You get 0.01% of it. Wow, billionaires. So we really don't like to build stuff up that way. We go use case by use case. We build the economics up from the bottom up. And, we do come to big TAMs in some things we see, but usually it's like 2 billion, which is still a great TAM for a startup. But if you look at the initial pitch deck, it might be 4 trillion. I will thank all the startups that on that list of 24 that most of you didn't really exaggerate much. So it was actually pretty cool that we didn't have to do too much of that. Finally, we seek deals globally. As you've seen on the list, we've had companies come in from all over the world. But our offices right now are in Seattle, New York City, and Bay Area. We're thinking very hard about what we want to do about Asia, but just given the velocity of deals we're seeing here, we'll deal with those first. We welcome and need co-op members' help. A bunch of deals have come from co-op members. We're really thankful for the deal flow. Some of the best ones, actually, because the difference between a warm and cold introduction is when you're making a warm introduction to a company, you usually wouldn't recommend something that you don't already like. And so we like those. While I'd say a majority of deals have just come from our individual networks, the ones that have come from the co-op members have been great. As a result, we've discussed this several times. Greg's mentioned this on our community hangouts. We're instituting a bounty program. We'll announce that soon. And just to be completely transparent, the reason why we've not arrived on one and particular numbers yet is just with valuation, deals, economics, et cetera, we look at what are the right comparables in the market, like what are other institutions doing, and we take best of breed and apply that. And so what we're going to do with the bounty program is just figure out what's an appropriate number there, appropriate percentage, et cetera. We're talking to a lot of funds about how they structure theirs. And so we'll come back with something that is vetted and already market. That's it from me.
You've heard us talk about this before, I think. We're from Seattle, some of us are, and I'm a big fan of the technology that's there. I know not everybody is in Seattle, but it's my home, and it's somewhere that obviously our chain is based as well. There's no reason that we can't make Seattle a blockchain hub, not just of the West Coast, but we think of the country, and we really want to do that. And we want to do that partly through the relationship that we have with our chain. And what we want to do is create that space in Seattle. If you know Seattle, it's down on the Pioneer Square location. It's hopefully going to be open by June, right, David? That's been an interesting task. One side note that I thought was kind of funny, one thing that has held up our lease, you guys may appreciate this, there was a clause in there about power consumption, and somehow we let it out to our agent that we were working around blockchain, so they took that as Bitcoin. So the landlord came back and said, we're going to be mining Bitcoin, so they're not paying any of the power. And it's like, that's how far off the outside world really is. We're a venture fund. You're going to mine some Bitcoin tomorrow, David? So anyway, it's crazy. So little things like that are slowing us down. But the point of the space is that we're going to have Reflective's going to be there. Our chain's going to be there. Greg has promised all of us that he's going to be in there 2 or 3 days a week. We're going to try to get as many of the hub companies or spoke companies up there as we possibly can. Some of them have already committed to put their blockchain developers in that space if they're remote, and they're going to come in and they're going to stay there until they get it all figured out. So everybody in this room is invited to come to that space, and we'll take them all. We're also inviting the community to come there, because I believe it's a place where all of Seattle and the Northwest or wherever, if you want to come and you want to talk blockchain, come on in, and we're going to host events. We're going to do everything we possibly can there. So that's a little bit about the workspace. One thing that we're getting structured right now, we get excited about this. Greg gets super excited about this. So it's our deal day, and we're kind of looking at this from our history in dealing with a lot of angel networks. Like this looks very similar to some of the angel groups if you've ever gone through that process. But we want to involve the community, and we want our chain to really be part of this. And at the end of the day, we want to structure this so that we can sort of package this up and have it be deal day in a box and take it to San Francisco and to Boston and to New York and to Berlin and Shanghai and wherever it is, and involve outside partners in that. But the core of it is for the community to be able to come together and see kind of what we're doing, see what David's talking about, what Renal was talking about, and how we look at deals. So the community can bring the deal flow to us on this one particular day. We'll put 4 or 5 of them on a committee to actually be in our office, and we'll of course stream it so you can be remote. We want to target 15 to 20 companies, bring them in, have them do the standard pitch to everybody. We'll narrow it down from there. There's a possibility that we're going to award the best deal a rock prize, and we do due diligence from the perspective of the community. It also gives the community a chance to talk with these companies if they want to potentially invest on their own. So this is something that we really want to do. We want to make sure that pushes out. We're shooting for our first event in June, whether it's in Seattle or San Francisco or New York or wherever those deals are. We're really, really excited about that. And that is it, I think. So we'd like to open it up for sorry. Yeah. Oh, okay. So we do have an event coming up May 3rd down in San Francisco. The Blockchain of Berkeley guys are helping us put that on. Very developer focused. It's going to be invites, so you got to go through. We'll have a posting as to how you can get into that event. Greg's going to come down and speak. I think we're trying to get Nash there as well. So that is happening on Thursday, May 3rd, down in San Francisco. We've got another one planned in New York. Later in May around the consensus event. That's some of the events we've got. Questions, anybody, for any of us? Yes, sir. You can find us on the Discord channel under Reflective, so we're posting there. Twitter, LinkedIn, the website is coming. Yes. Questions? Anything else? No. No. Yes. Yep. Some of them are further along than others. We like every single one of them, and as Renal said, the only thing that stops that is something happens with diligence or with evaluation. But you saw the first slide that we had up there. 12 is the objective that we had. We're moving fast. I mean, it's incredible how fast the team is moving. So if we can hit 24, I would guess that we'll do that in the next 30 days. That's pretty remarkable that we've doubled what we committed to do. The deal flow's there. We're seeing some great things. Yes, to this date, we funded 4, and I think there's 8 in the pipe that are ready to go in the next week or so. Yep. Yes. Good question. So the question was, do we, in case you didn't hear that in the back, do we actually provide funding, or do we provide developers to tie into the RChain platform? Yes, absolutely. That's one thing that we do in the incubation space that we've got. It's the whole purpose that RChain is there as well, so that we can do that. We will fund you to do that, and we will provide some of those other services that David talked about. So whether that's help on the TGE, whether that is on the marketing and the PR side, but specifically on the developer side, we are 100% on board with that, and we've got the support of Nash and his team, and we're bringing on our own staff to do that as well. Good question. Yes. We haven't run into too much of that so far. The case that we have run into it a couple of times is we're more likely to find those two companies can work together than against each other. But no, I mean, if we were to do that, there will be, Chinese wall between them, and the entrepreneurs will know that up front.
Do you take prorated rights if you invest in equity?
Yes. Do we take prorated rights if we invest in equity? Sorry. Alter.
Essentially, you follow along, you have the right to maintain our stake, and the answer is yeah. You're talking about preemptive rights, right? Yeah. So the idea is we take equity. A preemptive right allows the holder of that equity, say it's round one, that when round two comes, you are entitled to maintain your ownership interest at that level, whether it's 5%, 10%, 20%. So that's a preemptive right issue. We absolutely require that. Preemptive rights are only as good as your ability to fund it. You don't get more stock. You have to pay for it. So it's not harmful. It's just an ability to maintain. It's not harmful to the issuer. It's just an ability for us to maintain our ownership interest. So for the issuers, and I've been on that side of the table, it's actually not I don't think it's a bad deal. And unless you're sort of beholden to somebody you don't want to be beholden to, then it's a pain in the ass. Oh yeah. No, I mean, if it's interesting and it's working, then we're in. Absolutely. Yeah, I mean, yeah. No, this isn't a one and done deal at all. Yeah. No, it's a commitment. Do we go beyond this question? Oh, do we participate in follow-on rounds? Then the answer is absolutely. You know how that works, right? The follow-on round is either things are going so great or they're really not going well at all. So you're either trying to fill the hole or you're building. We know the difference. So a caveat to that participation follow-on round. Yes, sir. Well, we don't have any down market protection. So if the rock goes to 0.001, that's what we've got. So we don't have any down market protection at all. And did everybody hear that? Are we pushing a token generation event or tokenomics or requiring a token issuance if it doesn't either doesn't fit or at least it wasn't developed as an original plan from the company? Pretty much the question. And the answer is no. I mean, we don't believe that it makes any sense to shove a token structured deal down the company's throat if it doesn't make sense. On the other hand, there are companies that have come to us where their business model is pretty naturally suited for a token, and they hadn't really thought it through enough. And once you start walking through the different pieces of the business and how those could be tokenized, there's a discussion. We don't force anything. Look, if the company can't get their arms around it or doesn't understand it or is resisting it, it's not going to make any sense for us to demand it because it's ultimately going to be unsuccessful. So we wouldn't force it. But we definitely have brought it up in instances where we thought it made sense. And those deals are still in discussion. And then there are deals that we're working on. Well, one we've already funded, where there are so many tokenization opportunities, we haven't covered them all. So we haven't sort of nailed down every piece that could be tokenized in that market. The system can go down, I guess. No, I don't know if you guys want to take this, but generally the idea.
There's something I've. Did everyone hear the question? Okay, so the question's really about, say we've got a healthy set of companies that are all going to launch tokens in Q4. Does that create an unhealthy or healthy market, right? What are the implications of that? So I'm going to give a nuanced answer here. So there's two layers of economics here, right? There's the Rev token and all the other tokens. I'll start with the Rev token, right? The Rev token is a utility token. It's access to the compute resources that our chain gives you. the sum total of economic activity done on the platform should, over the long term, fundamentally drive the valuation of the ref token, right? You take any major like economy like the United States or Switzerland or whatever, and you see the total amount of money and the size of the economy, those ratios are actually fairly stable. So the ref token is going to be primarily driven just by how much economic activity is conducted on the platform. So the answer to that is the more economic activity happening on the platform, great, irrespective of what's happening at the above level. So now the level above that, right, I think it just comes down to, where it's tricky to answer is the market's immature, right? It's not gotten to where NASDAQ or NYSE is. But ideally, we're looking for companies that have extremely compelling use cases for the blockchain. So I actually don't think a multiple token launch is competitive at all, because I think the exposures are actually very, very different, right? If you bought a shop token, for example, versus an expansive token, one gives you access to retail, one gives you access to commodities markets, right? And hopefully investors over the long term, recognize that. But so nuanced, long term, I think it's not a problem. The market's so immature that in Q4 it's hard to say what happens. But, we think this is a decades-long thing, and we're investing accordingly. Yeah. No, I agree 100%. Just so you know, the comment at a high level was around, given there's likely a lot of fervor in Q4, October, November, December, as all these launch, market forces, it's hard to say what will happen. Look, I agree 100%. I can't control the market, right? But what I can control is the deal documentation to at least be as tight as possible as we can on our end. And we can help the companies structure their token economics. But yes, I agree it's food for thought. But sorry, I'm not able to give a super compelling answer. But I do think, just bringing economic activity onto the platform should reward long-term holders. So the comment was around spacing ICOs or token launches. And again, while we can't control it 100%, we of course would not do a release in adverse market conditions, right? Sure. The question is, could I elaborate on vertical agnostic? We're not limited to we're not saying we love healthcare, we love clean technology, we love supply chain. We think it's way too early, so we'll do any use case that makes sense. Yeah. Yes, sir. Our chain is an open source project, right? So we would be, it depends, right? If we can tick all the boxes on us living up to our fiduciary duties, of course. And the idea is compelling, of course. That's not an on-off switch. Sorry? No, it really depends on what the ecosystem is. So yeah, we could potentially be open to any of those also.
Not yet, not at this time. No, we're signing them up right now. So that is something that we could certainly look into. But right now I've got an email list that started already of companies that want to come in. No, we take the technology really seriously. So we've involved that, since we don't have a dev team on right now that handles that. We're working on a CTO now. So we've gone to Nash and we've gone to Pyrofex. We've gone to Greg for some of them. There's certainly the community members have vetted some of them. So that's kind of how we're doing it right now. I can't think of one company, correct me if I'm wrong, guys, that we haven't done a deep dive on the technology side of it. That's not going to happen.
The only caveat I'd add is if it's premature, it'll be baked into a milestone. Delivery of a technical specification must meet XYZ criteria. So yeah, to answer your question, how seriously do we take the technology in addition to the business model? Extremely.
Thank you, guys. Thank you very much.
Thanks all.